Hello and welcome along to the Property Academy podcast by Opus Partners. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about how long do you need to hold your property for in order to make money through property. And this is really interesting. CoreLogic puts out some fantastic data looking at the average time that people are holding their property for when they make money and the average time people are holding their property for when they lose money. And actually, they've done us a real solid here, Andrew. For the first time, we're going to look back over the last almost 30 years to see how those numbers have changed over time. But what's real fascinating, Andrew, is how long people are holding on to their properties for and how that's changed over time. Talk to us about this.
Yeah, so the really interesting thing, we always said that the average time that someone hold a property for would be 7 years, but actually that's not quite true anymore. So it used to be 7 years between 2009 and 2011, but it's been pushed out quite substantially. So it's now, on average, 11.2 years.
Isn't that amazing?
It's a huge increase.
And it has increased steadily since 2010. We've seen people just hold their properties for longer and longer and longer.
So this isn't that they're going to make a profit or a loss. This is just how long, on average, someone owns a property, be it an owner-occupied or a rental property. So the fact that we're holding on to properties for significantly longer, what does that all mean? And why would that be the case? I was wondering whether or not maybe with Brightline coming in, now people are thinking, okay, well, I've got to lock this in for a longer period of time because I don't want to have to pay income tax.
Yeah, that could make sense. But we didn't see the Brightline come in until kind of 2014 when it came in for 2 years. Now, You're right that even though the Brightline test was 2 years or 5 years and then 10 years, even though, in November 2014, the average time somebody held a property for was 9 years, even though the Brightline was 2 years, way lower than that, that could still push the average up. So you are right about that. But so that might explain the increase from 9 to 11 years as an average hold time. But ever since 2007, we've actually seen it increase. Between 2007 and 2014, when we saw the Brightline test come in, it's gone up from 7 years to about 9 years. So it's already went up by like 2 years. It's quite interesting. Maybe it's that properties are becoming more expensive.
Maybe.
And so then because it's such a large purchasing decision, mortgages are more difficult to get. Maybe people are holding on because they're like, well, I can't really move properties because I'm not going to be able to replace it. I might not be able to get the same mortgage. Now, Andrew, you're a long-time property investor. What's the longest time you've ever owned a property for?
I think that because I don't sell a lot, I think the longest would be 15 years would be my best guess.
Okay.
Yeah.
And usually on the show, how long would you recommend somebody holds a property for if they want to make money through property?
If I'm giving a general number, I'd normally say 10 years is the minimum you want to be investing in, particularly if it's, main locations, so Auckland, Wellington, Christchurch, Hamilton, Tauranga, rather than a smaller region. And 10 years is a good safe zone, if you can say safe, which you can't.
Yeah, but it also does depend on strategy. So if you're trading or you're flipping, it could be 3 months.
Oh, absolutely. Yeah. I'm talking about long-term holding for investing. If you're a flipper, then you might own that property for a day.
Yeah. So let's come to how long you've got to hold a property for in order to make money from it. And this has changed over time. So at the moment, if we look at April 2024, all the people who made a profit from property, a capital gain through property, on average, they are holding their properties for 9.2 years. If we look at the people who sold their properties and they made a loss, they sold their property for less than they bought it for, the average hold time was just 2.7 years. And we see a trend that we see all of the time in property, which is the longer you hold, the more likely you are to make money. The shorter you hold, the more likelihood that you are going to lose money. Now, let's be really clear. It's not that if you hold a property for 1 year, there is an absolute chance that you're going to lose money. Our numbers make it out to be over any 1 year period, about a third of a chance that you're going to lose money, 2/3 of a chance that you're going to make money. But if we separate the two groups out, the truth of the matter is, time and time again, generally, the people who hold their properties for longer make more money. The people who lose money in property are the ones who hold their properties for a shorter period of time. But what's interesting when I look at this graph, and obviously, Andrew, people listening on Apple Podcasts and Spotify, they're not going to be able to see this graph, but there are a couple of times where the people who lost money through property actually held their properties for longer than the people who made money from
Yeah,
property.
so someone's held onto a property for a really long time and still sold at a loss. That would be pretty heartbreaking if you're an investor.
Yeah, so recently that was 2016, and the numbers are basically the same. The people who made money through property held for 8.3 years. The people who lost money in property held for 8.1 years. So it's basically all 8 years. But isn't that amazing that back in 2016, a lot of people held their property for 8 years and still lost money through property. And one of the reasons that when I was thinking about why would that be the case is it's probably got something to do with the regional property booms. So between 2007 and 2016, if we look at New Zealand house prices, excluding Auckland, so just the regions, property prices were flat for about 8 years. So the average person who bought in 2008, if they then sold 5 or 6 years later, there is a chance that they've lost some amount of money just because many of the regions were flat for about 8 to 10 years. I think I've talked on the show before about Gisborne, where property prices went down for a sustained period of around 12 years before they took off again. So that's an example, especially in the smaller regions, where if you buy and even hold for 8 years, you could still lose money or see that property prices haven't gone up substantially because you might have just invested at the wrong time. Whereas during that period in Auckland, property prices took off between 2012 and 2016. So all of those people who made a gain, maybe a lot of them are in Auckland or the surrounding cities. That's one thing that I'm picking up.
Yeah, I think a really key thing to remember here is that not all it's not like every region goes up at the same rate all of the time. It'd be lovely if it did. It'd be really easy to forecast your growth, but you've got to be really careful. A, how long you're holding a property, but B, if your area you're going to invest in is actually at the right time in its property cycle. And time does heal all wounds, or most wounds, when it comes to most things, but certainly with property investment, the longer you can hold, the more likely you're going to get a favorable outcome.
Doesn't help with heartbreak. The other thing that maybe we'll cut that out. Now, I don't want to. Now, what's really interesting is when we compare those two groups, people who made a capital gain and people who lost money, who didn't make a capital gain, where their properties went down, 97% of the time, the people who made money through property held their properties longer than the people who lost money. So only 3% of the time did the people who lose money hold their properties for longer than the people who made money. So the key message is always, it's just a data-driven way to say the same message again and again, which is the longer you hold, the more likely you make money. And this is a really important message right now because there are some people who purchase properties at the peak of the market in 2021, maybe even in January 2021, where the market hadn't peaked, and your properties may have gone down in value. In fact, Auckland house prices, they fell about 22% from the peak of the market down to the bottom of the market, and were not that far above the bottom of the market from back in May 2023. And so for some people, they're tempted to say, this has been a nightmare. I want out of this mess. I'm just going to sell and take the loss. But the message is, and the data shows this, the longer you hold, the more likely it is. And so I know you've had to say this to a number of investors, Andrew.
Just yesterday, I was talking with an investor of mine. She and her partner bought their third investment property in Auckland right at the peak of the market. Has had very good success with the first two properties. They were bought in Christchurch while it was undervalued. They've gone up significantly. Then they got in Auckland at the peak of the market. It's dropped. Now interest rates are crippling them and they're backwards in terms of value. So they wanted to get my advice on what they should do next. And they're doing some things to consolidate their expenses and try and get have better cash flow. But the key message to them was you need to weather the storm because now interest rates are heading in the right direction. Give it 12 months, all of a sudden they're going to be topping up the property, but nowhere near to the same extent, about half of what it will be today. And if they can get through that rough patch, then we'll start to see some positive movements in values, I imagine. And it's much easier to put in a couple of $100 or $300 a week top up when your property's going up in value. You don't mind as much when the property's going up in value.
You feel a little bit better about yourself. And I suppose the other thing is, everybody who has started watching this video, listened to this podcast, you probably knew this before coming in. But sometimes you just need to be reminded with data to say, oh yeah, that's true. I'm going to keep holding onto this property. There are some other trends that I've observed about the gains, though, that's really interesting, Andrew, which is that back in 1996, to make a gain through property, the average person held for 4.3 years. Now it has substantially climbed to 9.2 years. So it's aligning with that other data that, hey, part of that is just that people are holding their properties longer. So, of course, that number's going to tend to go up over time. After all, most people do make a capital gain through property. But what do you think's driving this? The fact that people are holding their properties longer to make that gain?
Yeah, it's an interesting one because don't know, so it's going to be best guess. But I wondered whether or not, because nowadays, you think about household income to purchase price, it is significantly more times your income to buy a property nowadays. So I wonder whether or not previously, and 30 years ago, whether or not people had the ability to upgrade their own house faster. And so maybe, they got on the property ladder and then they would sell and they'd move houses every 5 years, which is still a relatively short period of time. I can't imagine moving that frequently, but possibly that's it.
What's really interesting as well is the people who've made a gain held their property for 9.2 years. That's actually slightly lower than the average hold period that we've seen, which is 11 years. So actually, now that I think about it, it's probably more explained by that rather than trying to find some deeper meaning. What's really interesting is just how the people who make a loss through property, the average hold time spikes when the regions are not doing particularly well. So there are two messages in this, not just hold your property for longer, or hold on to the property if you're thinking about selling it, generally speaking, not formal financial advice, but also think about the region you're buying. If you're investing in those smaller regions and they're flat for a time, that's where you can still hold your property for 8 years and make a loss and see that property decrease in value. That's one of the reasons why for the last 5 years we've been banging on about being a bit hotter on those bigger centres. It's not necessarily that places like Christchurch or Wellington increase in value faster than other areas. They don't really, but the growth tends to be a bit more consistent. Right, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you're listening to this on Spotify or Apple or any other podcast app, you want to see some of the graphs, just Google Opus Partners YouTube. It'll be the first thing that comes up. If you're watching on YouTube, make sure you hit that subscribe button. We release new videos on here every Monday and Wednesday. Thanks for listening to the Property Academy podcast. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
We're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.